Hi traders, in this video I'll explain basically the 7 Ict Institutional Reference Points you must know to improve your trading skill as a smart money concept trader. There are 7 institutional reference points. Number 1 is the mitigation block, number 2 is the breaker block, 3 liquidity void, 4 fair value gap, the 5 order block, 6 rejection block, 7 hold high and hold low. So let's dive into the video as I explain this basically. A mitigation block is simply a failure swing. It's a failure swing, and there are two types of mitigation block: the bearish mitigation block and the bullish mitigation block. Now let's identify this bearish mitigation block. So this market created a high here, a low, a high again, then return back. Now this is the failure swing. This didn't take out the previous high, it stopped here. So we want to wait for price to break this low and retrace back to that same point. So the last bearish candle here is actually our mitigation block. So we just observe and wait for price to get to that last bearish candle, then to start reacting from there, then we short. That way if you are taking this trade, we can put our pending order here and stop loss here, then we take this trade all the way down. And now for a bullish mitigation block, so price created a low, created a higher, that's a higher high, now a higher low. Now this is the failure swing here. This point didn't take out this previous low, so it stopped here. And so you want to wait for price to break out, to create a change of character and retrace back to this last bullish candle. So we want to wait for price to retrace back to this bullish candle before we take this trade, and we can set our pending order here, so our stop loss here. So the moment price return back to this candle, to this order block, it starts going up. That's a mitigation block. So let's look at it in the chart. I already marked one here. Let me delete this and explain. So you can see what price is doing. Price created a high, a low. This is the last bearish candle here, and another high again, and took out this one. So price broke this one, and so price is now reacting from this order block here. Price is reacting from this last order block. You can see how price traded into it. Let me delete this. Price traded into it, the last bearish order block there, and started dropping. So you want to put your pending order here and wait for price to get to this point to activate you, so your stop loss will definitely be around here. Stop loss can be here if you want to be very conservative, or here you want to give it more room to breathe. So that is it for mitigation block. A breaker block is simply a failed order block, and there are two types of breaker block: the bullish and the bearish. Now for the bearish breaker block, you want to see price take out the previous high, as sweeping the liquidity there and creating a change of character, and you want price to trade back into this bearish order block. So the last candle there, the last bearish candle, is your breaker block, and you want to take your trade from here, and your stop loss will be above here. You want to take your trade from here. Now same thing goes for the bullish breaker block. You want to see a sweep. You want to see a sweep here, a sweep of the old low, and then a change of character here, and then you wait for price to come back to this bullish order block. The last candle there is actually the bullish order block. So you want price to come back to it before you take your trade. Before you take trade here, and your stop loss will be here. The difference between a breaker block and an order block is that a breaker block sweeps liquidity. It sweeps the previous high or low, Why a mitigation block doesn't sweep? It's called a failure swing. So it didn't swing to sweep, it stopped there. It stopped here, and price, this is just the difference between a breaker block and a mitigation block. Same thing for a bullish. A mitigation block want to stop here, it won't sweep, but a breaker block will sweep the previous low. That's just the difference. So this is an example of a breaker block. You want to see a sweep of liquidity here. You want to see a sweep of liquidity, then you want to see a change of character above here, and the last bullish candle here is our breaker block. So you want price to trade back into it before buying. So this is how it is here. So this example, and price went up, came back, retraced back to it, and boom. So this is just how a breaker block is. So you want to set your, you want to take your trade from here, and your stop loss will be below here, and you target this 1:2. This to give you 1:2 nicely. Yeah, so this is simply what a breaker block means. A fair value gap is simply an imbalance in price action, and it is identified by the space between three candles, and this is number one. This is candle number one, this one here, this is number two, and this is number three. And so this space between these three candles is the fair value gap. And also there's another space between this candle, 1, 2 again, and 3. There's another space, a small space here, is also your fair value gap too. Let's identify. So this is a fair value gap here. This space between from here to this point is a fair value gap. Then also from here to this point, from here, is also a fair value gap. That price will definitely go to mitigate. Here there's a small fair value gap here, there's a fair value gap here. You can spot this. So it's just the space, and this is a big fair value gap. This is a fair value gap, so it's simply an imbalance. Price will definitely come to fill it in. That's simply what fair value gap means. So liquidity void is also an imbalance in the market, and all this area, the buy side, this side where the buy side were void of liquidity, everywhere here were liquidity until the sell side started taking out the void here. So it filled everything here. So this is the liquidity void that has been filled. So price has filled the void of liquidity here. It took out, this one, took out this liquidity, took out this one as well. So you can see nicely. So this is basically what liquidity void means. An order block is basically where institutions take large orders, and there are two types of order block: the bearish order block and the bullish order block. And for a bearish order block, whenever price comes to a bearish order block, it pushes price bullish, and whenever price comes to a bullish order block, it pushes price bearish, like so. If price is coming down again to a bearish order block, is going to push price bullish. So this will be our order, there will be an order block here as well, to push price bullish. Same thing with a bearish, so when price is going up to another block, it will push price bearish. So the bullish order block push price bearish, while the bearish order block push price bullish. I guess this is simple enough. So a bullish order block is the last bearish candlestick, while a bearish order block is the last bullish candlestick, because it is where the move started from. So on this is a bullish order block. This red candle here is actually a bullish order block. That was what created this move. So this red candle created this move. That's the order block. There's another order block here again. This red one now created this move. That's another block. So this is another block that we're expecting price to trade to. This red bearish candlestick. Now there's another order block here. This last one, now this last bearish candlestick, it was what created this movement. It created this move to the upside. Now I can spot another big order block here. This one from here down to this point is another order block. Yeah, so it's the last bearish candle. So you can see how price traded into it here, and boom. So that's for bullish order block. Okay, so we can also see they are everywhere. Now this one, now for a bearish order block, so this last bullish candlestick is your bearish order block. So you can see how price traded into it. Price traded into it, came back, traded into it and start short. So it was this candlestick that created this move. It was a candlestick that created this move all the way down. That's basically what order block is all about. That's basically what order blocks is all about. So you need to train your eyes to be able to spot these things. You can spot another order block here. This bullish candlestick, you can see it. You can see that's another block. How price traded into it and started shorting from there. So it's everywhere. You just need to train your eyes to see it. So this is basically what order block means. A rejection block is simply a selling or buying zone where price reacts with multiple long candle wick. Now this is a rejection block. You can see this wick here. We can start from a 1, 2, 3, 4, 5. There are multiple. So this is a selling zone, and if we take it back, we can see rejection block with long wicks. So these are multiple candles here. So you want to watch out for this. You want to watch out for the price always react here, and you can see it down here as well. These are multiple candle wicks there. So this is basically rejection block. You can see them where they have multiple wicks, multiple candle wicks. So when price, you can see as price traded into this around this zone, it just reacted and changed direction. So we need to just watch out for this. We train our eyes to see these things. These are rejection blocks. This is a rejection block, multiple candle wicks. So you just need to train your eyes to see this thing. Yeah. Old highs and old lows is simply a draw on liquidity. So we can see this old low here. We can see how price came back to sweep the liquidity here, and that's what it's likely to do to this old high here. Price is going to hunt for the liquidity there. So that's basically what old lows and old high mean. So price could do something like this and target this liquidity here and come back again to take out this old low here. That's basically what price do with old highs and old lows. So this is a brief explanation on the 7 institutional reference points, and in subsequent video I will do a detailed explanation on each one of them. Thank you so much for watching. I hope you found this video helpful. My name is Charles Ibeh. Kindly like and subscribe. See you in the next video.